Good afternoon. The recording is taking place past midday, close to 2 p.m. This is a recording by MAT Abacus Business School. And our focus today, we need to do a debrief. We need to do a debrief on the recent mock that took place around April 2026. This is CPA level 3, and specifically the debrief is on advanced financial management, commonly known as AFM. Ideally, we don't have enough time, but by now, you must be well conversant with these instructions. And it is important, even when you enter the exam, as you wait for the invigilator to guide you, kindly read through, but more so, for advanced AFM, whatever you're going to do there, you will be required to write a report. The examiner confirmed the report will take a memo format, and it will be, you'll need to address it in the question. For every question, you have to address it by starting with to, from, then the date. Please note, you have to indicate the exam date. Don't write the word exam date. If you are looking at question 1, if it is question 1, that should have appeared on top. Then you should be able to indicate to, from, date, subject, evaluation of the proposed investment, if you are dealing with question 1. Ladies and gentlemen, those who will manage to access this video, I'm assuming that your answer booklet will have a covering page. This is where you'll put your credentials as guided. And therefore, when you go to page 2, it is where you will do your report if you're dealing with question 1. Therefore, you'll be able to indicate to, from, date, and write the subject. Possibly, you carefully indicate evaluation of the proposed investment if you're dealing with question 1. Now, at that stage, you may leave that space and go to page 2. It is on page 2, you'll be able to lay your NPV table as previously illustrated in class. So you'll be able to lay your NPV table template. Possibly it will cover the whole page. And therefore, once you lay it out, you may not populate it. Then you will go to page, if this is page 2, this is page 3 where you are laying your NPV template. Then you will go to page 3 and you start doing your workings. The examiner prefers you indicate that these are annexes to the report. After doing your workings, depending on how many workings you have, once you are done with your workings, it's when you will come back to page 3 to complete your NPV table. And it is from page 2, we do hope that eventually you'll be able to get your NPV or possibly your PI, profitability index, or your APV, and then you come back to page 1 and carefully, page 2 and carefully now go. If the subject was carefully indicated, then you go and introduce the subject. that possibly you are submitting this report, I'm just illustrating, in fulfillment of my engagement terms as a financial manager of the company. It is in this report, it is in this introduction that you will be able to indicate other parts of the question. You can't put all these other parts in the subject. Keep the subject short, maximum one line there. Don't go beyond the one line. Other details of the question will be able to appear there. Then carefully start 1A. It's where we are talking about evaluation of the proposed investment. At this stage, you are basically concluding, whereby you will be able to say the proposed investment is financially viable with an NPV, if you are dealing with NPV of so much, if it is positive, implying that it will add value or value to the wealth of shareholders, and thus it should be undertaken. You should be able to end there, but if you wanted, you continue writing. The detailed evaluations and NPV computation are provided in the annex below. So you will be able, that means once you say in the annex below and you have already concluded, that means now you'll be able to see your NPV table and the workings will continue. If you stopped on page 5, then now you can continue with your 1B. Once you're done with your 1B, you go to 1C, etc. Ladies and gentlemen, should time get you before populating the NPV table, make sure in the NPV table you bring in those other cash flows that possibly do not appear in the workings. In most cases, the initial capital or the initial outlay may not actually have a working. So you need to come and show it quickly in the NPV table if they are telling you you're left with 5 minutes, etc. But also scrap. At times you might leave it in the question because you didn't have enough time to come and populate this table. So you need to work smart. You move forward and populate the table so long as they are telling you you're left with 2 or 3 minutes and you are aware there are those elements or cash flows that actually do not appear in the NPV table. That is my early introduction, but all in all, question 1, according to our mock that took place in April 2026, we had question 1, and therefore it is important before we read through, we get to understand the required. The required, we need to look for that question 1 such that we get to know the required. The required says, prepare a paper to the Chief Executive Officer suitable for presentation at the next board meeting. That paper is called Talking About, is the report I have simply illustrated. It says, Part A, an evaluation of the proposed diversification to the cosmetics sector, 29 marks. So obstacle number 1 here, we do not know what tool to use. And therefore at this stage, you cannot quickly talk about what tool to use unless you read the case, the scenario very well. But in most cases, the common tool we use is net present value, but it is subject to the case or the scenario before you. Part B, they want an advisor on the appropriate portfolio of investments to undertake using covariance analysis or covariance theory This comes from portfolio theory, and therefore everyone should have had that 8 marks with ease. And part C, a justification of the opinion of the finance manager and the discussion of the composition and role of Sharia Advisory Board. This is Sharia Advisory Board, not council. But pay attention. There are 2 questions in one. There is a part saying you discuss the composition, and then the other part is the role of the Sharia Advisory Board. 7 marks. And then part D is a justification for complying with sustainability and environmental management practices to organizations like DHL. To me, this does not require any textbook knowledge, simply because one could have applied common sense, more so what is happening in the world, specifically in Uganda, and more so what is happening in your home village. Therefore, this was the easiest to deal with as you move to part C before hitting part A and part B. My focus on this debrief is on question 1. We don't have enough time to look at question 2. And therefore, without further ado, we are going to look and read carefully question 1, because by now we haven't understood what tool we are going to use. My name is Geofrey Karubanga, a senior lecturer of financial management, advanced financial management, CPA papers at MAT Abacus, but I also lecture at Heriot University, based in Scotland, and there I specifically focus on financial decision making. And for those who are taking on electives, I also handle another paper known as advanced financial decision making. I also support those who handle a paper we call mergers, acquisitions, and corporate restructuring. For those who have never known or seen my face before, today I have put on a video, and therefore do not waste time moving from college to college. Always recall that actually MAT Abacus Business School is the market leader in issues to deal with, enabling students to pass advanced financial management. We have had top students in both financial management and advanced financial management since June 2022, and we have not been challenged, and I don't expect any challenge this sitting. Now, question 1. Deluxe Holding, give me a second. Deluxe Holding was established in the year 2000 and operates in the textiles sector. Since incorporation, DHL has controlled a significant market share of the textiles sector in Uganda and has established regional outlets in the neighboring countries in order to increase its regional presence. At its recent board meeting, it was resolved that the company diversifies its operations to cosmetics industry. Remember, we were told to evaluate whether you do a diversification in the cosmetic sector is actually viable. But we were not told which tool to use. So its operations to the cosmetic sector by establishing a production facility that will produce a wide range of cosmetics for sale in Uganda with a few exports to the regional market. Ladies and gentlemen, in this paragraph, it is more of introduction, which is necessary. Now, DHL has an equity beta. Equity beta. You should recall, we have always had 3 types of betas. Should recall, we have always had 3 types of betas. So, we have, if I indicate here types of betas, we have got 3. One of them is what we call equity beta. One of them is what we call equity beta, abbreviated as beta is a Greek letter. What does equity beta tell us? One, it means that DHL has both debt and equity in its capital structure, That's what it means, that this company is actually geared. This company is technically geared. And therefore, when they are telling us we have got equity beta, it means this company is technically geared. They are using both debt and equity in. But on the other hand, in terms of risk, equity beta means that you are going to suffer from both finance and business risk. Ladies and gentlemen, we are continuing to do our debrief. The other type of beta is what we call asset beta. Asset beta, abbreviated BA. Asset beta, some of you have challenges of reading it. You want to read it as beta asset. Please respect our industry. It is read as asset beta. And therefore, if you find it in the exam next week, get to know what it means. Asset beta means that the company, asset beta means that the company has only equity in its capital structure. Okay. Asset beta means that the company has only equity or uses only equity in its capital structure, i.e., it means it has no debt. It has no debt. And therefore, if the company has no debt in its capital structure, it will only suffer from business risk and not debt. Finally, we have got what we call debt beta. Debt beta, abbreviated as BD. It means that the company uses only debt in its capital structure. And therefore it will only suffer possibly from the risk of default. So when the question tells you, ladies and gentlemen, that actually when we go back and read the question, it says that DHL has an equity beta of 1.15 in it, and its existing capital structure comprises of debt and equity. This is spoon feeding. So long as you have been told that the company has an equity beta, be reminded in your medulla oblongata that actually you have debt and equity, and we have been given the proportions in percentages respectively. Mark the word respectively. The first one appears as debt, and therefore debt would be 35%. But we are also being reminded, which also reflects the company's debt capacity. No problem. Preliminary data has, this word should be has, preliminary data has revealed that the cosmetic sector has an average equity beta. Oh, we are diversifying. Okay. Therefore, since we are diversifying, they are telling us data from the cosmetic sector has an equity beta of 1.35. At this point, you should be able to recall what Modgillian and Miller said. Modgillian and Miller said that companies in the same sector suffer from the same business risk. And therefore, business risk is represented by asset beta. Okay, but here I've been given the cosmetic sector has an equity beta. All right, what does that mean? That the other company where I'm gonna go, where I'm going to invest, diversify into the cosmetic sector is actually geared. Yet Modgillian and Miller said companies in the same sector suffer from the same business risk, and therefore do not waste time trying to analyze the business risk of that industry. But because we have an equity beta, does it mean we shall need to trace later the business risk of cosmetics sector? But we are also told that the debt to equity ratio of the cosmetic sector is 2 out of 3. Sorry, it is 2 to 3. Okay, but earlier we were told DHL has debt of 35%, but yet it has been given in terms of ratios. All right, therefore we should be able to know how do we deal with the ratio to get the appropriate fraction possible for debt and the appropriate fraction for equity. We are being told any diversification to the sector will increase the capital gearing to 45%. No problem. The proposed diversification to the cosmetic sector will necessitate initial capital expenditure of that. All right, we are evaluating the project. Most likely this is relevant and required initial capital structure of 9.5 billion required to finance acquisition of production machinery, installation, and setting up the facilities to be ready to commence production. DHL has so far, mark the word, has so far spent 340 million to carry out studies necessary to inform the company's investment. Please note, this is likely to be a sunk cost because you are hearing the language that DHL has so far spent 340 to carry out preliminary studies necessary to inform the company's investment decision. The proposed investment will yield benefits for a period of 5 years. Meaning that this project is going to run for 5 years. The other point is track and see how a tax is going to be paid, after which it will be scrapped at 20% of the initial capital structure, meaning that of the initial capital expenditure, there is a small working there. You could earn yourself 1 mark. The annual revenue expected from the proposed diversification is estimated at 7.5 billion. This is revenue. That is revenue in the first year of operation OTO. This is strictly year 1, increasing by 10% in each of the subsequent years, before declining by 5% in the final year. Mark that word, before declining by 5% in the final year. The direct costs associated with the proposed diversification are estimated at 35% of the respective revenues for year 1 to year 3. Mark that. And then at 45% for year 4 to year 5. All right. Diversifying operations to the cosmetic sector will increase DHL fixed costs. Mark this word, currently at 2.4 billion by 30% in the first year. Meaning there's something here funny, that currently DHL incurs a fixed cost of 2.4, and once you diversify, that will go up. It means there you might need to track down and tell us which one is relevant. We shall be able to sort out that. But then we see a kachumbari here that says the relevant fixed costs will increase by 8% annually in each of the subsequent years, before declining by 6% annually effective year 4. In addition, the diversification will necessitate additional investment in working capital equivalent to 40% of the company's existing working capital of that. Okay. The relevant working capital will increase by 15% in each of the subsequent years until its recovery in year 5. The proposed capital expenditure will qualify for annual capital allowances at a rate of 25% on reducing balance basis for only 4 years. DHL pays a corporation tax at 30% payable in the year in which taxable profits arise. Okay. But has negotiated with the tax authorities and received approval to pay annual corporation tax in arrears. Oh, that means this project that was originally 5 years is actually going to be, we are going to draw a table reading 7 means 6 years. And this approval will be applied to the proposed investment. All estimates of cash flows stated above are quoted in current terms. Meaning that not yet adjusted for inflation, and will be affected by annual inflation, which is projected at 8% effective year 2. The proposed diversification will be financed by both debt and equity in DHL's existing capital structure. The debt finance will be sourced from TEFE and Uganda Development Bank. TBL is willing to finance amounting to 1.7 billion at an annual interest rate of 20% for a period of 4 years, and there is an associated issue cost of 5%, while the balance of debt finance will be financed by a 5-year subsidized loan. That word now is a game changer. 5-year subsidized loan from UDB at an annual interest rate of 8%. All interest costs are repayable at the end of each year. Principal is payable at the end of the loan period, and debt finance is assumed to be risk-free. When debt finance is assumed to be risk-free, then debt beta is approximately 0. The equity finance will be raised through a rights issue of 2 shares for every 3 shares held, as at the end of issue, with associated issue costs, which are tax deductible. Interesting. The risk-free rate of return is 10%, and the annual average market return on investment in the cosmetics sector is 21%. This is what we call RM, and this is what we call RF. As an alternative financing option, MS Kitufu, the investment manager at DHL, has proposed use of Islamic financing, since it is argued that such financing structure eliminates commercial risks that are inherent in conventional finance. However, this view is objected to by the finance manager, who contends that indeed there may be risks and drawbacks arising from the use of Islamic finance, and that none of the financial institutions in Uganda has constituted Sharia Advisory Board as a prerequisite for rolling out Islamic banking in Uganda. Alternative investment. As an alternative diversification, DHL is also considering committing funds to a portfolio of investments in order to dilute risks that may arise from concentration of investment in one sector. Depending on the brand class, the proposed investment were codenamed Kings, Bishops, and Queens. The investment will require equal capital expenditures, and are expected to yield the following returns depending on economic conditions prevailing in Uganda during the investment horizons. And once you realize and see this type of table, you are going the portfolio way, and we're being told that DHL has a capacity to generate capital that can finance a portfolio of only 2 investments, but is not sure of the most appropriate portfolio of investments. Notwithstanding the financial viability of the selected portfolio, the manager corporate services at DHL, who is also charged with the role of enhancing corporate social responsibility, has advised that the selected portfolio should also meet the environmental, social, and governance objectives as championed by several global and local environmental agencies. As such, special consideration should also be placed on the sustainability and environmental management issues that may arise from undertaking the selected portfolio. You have been engaged as a consultant to provide investment advice. The portfolio question is in part B, but for this debrief, I will focus only on part A. Part A, they want an advisory or representation, an evaluation of the proposed diversification to cosmetics industry. Now, we have not been told which tool to use. The case we're looking at stops here. This is portfolio, this is portfolio. That's where part B is. But when we carefully look at what we've been reading, one could think that you go the NPV way. But when you reach somewhere and you look at the financing structure, we are being told you are going to borrow from TBL at 20% for a period of 4 years. And of course, there are issue costs. And the balance will be a subsidized loan from UDB. In any question, the day you find a cheap loan or subsidized loan, the appropriate tool to use to evaluate that is the adjusted present value, commonly known as APV. And that is the subject of the matter right now. So now, whenever we are dealing with APV, whenever you're dealing with the adjusted present value, commonly known as APV, then you should recall that actually APV is an investment appraisal tool that separates the investment decision. It separates the investment decision from the financing decision. And therefore, because of that, APV will be the investment decision plus the financing decision. To further break it, what that means, it means that APV is going to be best case NPV plus the present value of financing effects. Now, when I say APV separates the investment decision from the financing decision, in other words, the two are done separately. Please note the rules of the normal NPV remain. And therefore, what do I mean? Always identify relevant cash flows. Always identify relevant cash flows. However, the other key separating point is when you're dealing with the investment decision, which we are calling or taking to be the best case NPV, it means you will follow those rules but discount discount all cash flows under base case NPV, comma, using what? Using the ungeared cost of capital. The ungeared cost of capital, which we commonly abbreviate as KEU, or some books read it as KE with a slash on top. Therefore, if I'm going to separate the investment decision from the financing decision, for the sake of doing APV, adjusted present value, then I'm going to get the best case NPV, identify relevant cash flows in the case, using the rules of investment appraisal. However, those cash flows for best case NPV, they must be discounted by the ungeared cost of capital. And therefore, using CAPAM, the ungeared cost of capital is the risk-free rate. The risk-free rate plus asset beta into the market return minus the risk-free rate. Now, if you read that equation, they tell you that DHL is actually geared. We do not have the asset beta formula. Therefore, that's why you are reminded, what did Modigillian and Mira tell us? Modigillian and Mira created a formula we call, let me look for the formula, but I can write it. I thought I have it here. What we call the asset beta formula. And therefore, Modigillian and Mira was able to generate for us this formula that the asset beta is the value of equity divided by value of equity plus value of debt, but adjusted for tax, plus times equity beta plus value of debt adjusted for tax divided by, let me check on the formula sheet. Yes, that is it. Divided by what? Wait a minute. Divided by value of equity plus value of debt adjusted by tax times, you multiply by debt beta. Modigillian and Mira, even the question tells us, but if the question had not told us that, we could assume debt is risk-free. Assume debt is risk-free. And because debt is risk-free, the debt beta is always approximately to be 0. And therefore, if I plug in 0 here, the whole of this will narrow to 0. And it was concluded that asset beta is equivalent to value of equity divided by value of equity plus value of debt adjusted for tax times equity beta. That is the formula you will use to attempt and get your asset beta. We have spoken a lot about investment decisions, and therefore now the other part or component is the financing decision. When you're dealing with the financing decision, we are interested in the present value of the financing effects. And this shouldn't be a problem. Key among others is we shall need the tax relief on debt. We shall need possibly to deal with the net savings, the net savings benefit on the subsidized loan, and finally, you might need to deal with issue costs. Once these are identified, there are always those three elements. All of them can be in one question or only one or two, but always remember the financing effects. The financing effects are discounted using the cost of financing, of borrowing. But your examiner prefers more of using the risk-free rate. That's what we shall use to discount those financing effects. And once that is done, the question is done. Therefore, let us start. I will give you 1 minute to rest and pause again and read through the question. And just 1 minute or two. 1 minute or two. Yes, we had a break of 1 minute. So we have agreed from my earlier presentations that actually we are going to deal with NPV. So I will go and set it up. So when we set it up, I'm going to use Excel. And therefore, we are doing MAT Abacus CPA, MAT Abacus Business School. And we are looking at a mock CPA mock examinations. And the paper appeared April 2026. And we are doing question 1, part A. I'm trying to set it up. We are trying to do an evaluation of, the question was, let me check, the question was evaluation in what? Evaluation of the proposed diversification, and we have agreed we are going to using the adjusted present value, commonly known as APV. And we have said APV, we shall need to get the best case net present value, and we shall do our best case. Possibly I'll do it in UGX. I'll do it in the UGX of millions, and we'll have the year. I'll have year 0, year 1, year 2, year 3, year 4. The project is 5 years, but because of the tax-related issues, we shall add on that 6 year. Because the question carefully says you will be able to do that using the adjust. You will be able to do your taxes, pay your taxes. Your taxes will be paid in arrears going forward. Therefore, this is my template, and now I can go and look at my workings or annexes, whatever workings, or I could call it annex or appendix. And therefore, some I will be doing them in Excel or others on the whiteboard. Now, when we go to the question, our starting point is to get the appropriate, my working capital, because this one we threw it out. There's this paragraph. It says that DHL has an equity beta of 1.5, and therefore, since the equity beta of 1.5, we should be able to look at that. So working number 1, so I'll be using both. Working number one, we are looking for the asset beta, because we have been told from the question, if you look at the question, they tell us that DHL has equity beta of 1.5, 1.15, and the debt is at 5%. So we quickly recognize that DHL has equity beta of 1.15, but we have also been told debt, the value of debt is 35%, and the value of equity is basically the difference, which is 65%. What we are looking for is the cost of equity. We know because what we are looking for is actually the cost of equity ungeared, which is the risk-free rate, plus the asset beta, because we have to get the ungeared into RM minus RF. So that's why we are looking for the asset beta, and using the Modiglian and Miller asset beta formula, we are aware that asset beta is always equal to value of equity divided by value of equity plus value of debt adjusted for tax times we multiply by the equity beta. We are interested in asset beta, and therefore from here our asset beta is going to be value of equity is given as 0.65. To avoid problems, divided by 0.65 plus 0.35 at 5% into 1 minus the tax rate. The tax rate was 30%, and then you multiply here. Some of you keep on asking whether the multiplication extends on top. Yes, you multiply by 1.15, and when you work out that using your calculator, you will get your equity beta, your asset beta being 0.92, and hence the cost of equity the cost of ungeared beta, mean the cost of the ungeared cost of equity, KEU, is the risk-free rate. We were given the risk-free rate as 10% plus the asset beta, which we have got as 0.92, into the risk-free rate, which was 21%, minus RF, which is 10%. And when you get that, we shall be able to get approximately 20%. That is the ungeared, this is the ungeared cost of equity of DHL. Hence use it, hence use it to discount the base case NPV cash flows. That is the instance of that, the ungeared cost of, you'll get some marks, about 1 or 2, etc. Therefore, in Excel, we had put that heading, we had indicated that we are going to do our base case NPV. That's what I indicated here. And therefore, that's what our interest is. And we have already sorted out our cash, we've already sorted out the cost of equity. So we go back to the question and now begin identifying the relevant cash flows. We shall be able to come back no, there's something I didn't read. Let us see. Sorry, I made a mistake here. Let us read. DHL has an equity beta of 1.15 and its existing capital structure comprises debt and equity in proportions of 35% and 65% respectively, which also reflects the company's debt capacity. Preliminary data has revealed that the cosmetics industry, there is a slight mistake I've done. Let us correct that. The concept. There's a mistake here. There's a mistake here. There's a mistake here. There's a mistake here. Now, we are dealing with a diversification. Since we are dealing with a diversification, it means that we are going to go into the cosmetics sector. That's why we were given this information. We have an information that indicates there is this information. I had skipped it. Preliminary data has revealed that the cosmetics sector, it is that sector we need to ungear such that we retain the business risk represented by asset beta. Therefore, the cosmetics industry has an equity beta of 1.35, but debt to equity is 2.3. We sort out that. If debt, slight error, we are being told debt to equity is 2 to 3. It means debt is 2, and it also means equity is 3. Therefore, here, when the formula says value of equity It is basically 3 times the equity beta of the cosmetics industry, which is 1.35. You divide it by the value of equity, which is 3, plus the value of debt, which is 2, adjusted for tax. Which is 1 minus 0.3. That when you do that, it's when you get 0.92. It is the cosmetics industry where we are diversifying and we are interested in the business risk. Therefore, the business risk of cosmetic industry is 0.92. But we should also be aware that when we are dealing with an geared cost of equity, we specifically discount the cash flows using the ungeared cost of equity, which we have managed to use 20%. And therefore now we are going to start looking for the cash flows. Carefully, let us go back to the case. So we seem to be done with this paragraph. And now I'm looking for revenue. The proposed diversification to the cosmetics sector will necessitate initial capital expenditure of 9.5. Me, I'm in Excel, I could have taken that. Required to finance the production of machinery, installation, and setting up. DHL has so far spent 340. What you do with the 340, you go and put a note. You go and put a note, note 1. You go and put note 1. Expenditure. Expense, how was it written? Let us read it again. The 340. Okay. Preliminary cost on studies of UGX 340 million is not relevant. Don't leave it in the question paper, write it down. Is not relevant. So we continue reading. So we have taken that, but we haven't taken the 9.5. I will bring it later. We have looked at 5 years, but there's scrap. So we need to get that scrap. We can do a working 2. Working 2 is basically scrap value. And they are telling us scrap is 20% of what? Let us read it again. Scrap is 20% of the initial capital expenditure, and we are told the initial capital expenditure is 9.5 billion. So it will be 9,500 million. And when you do that, let me use my phone. When you do 20% of that, give me a second. When you do 20% of that, 9,500, it was in billions, I've converted it. You'll be able to get your scrap. Your scrap is UGX 1,900 million. That could earn you 1 mark. ETC. So we have taken the scrap. We have pulled out that. This one hasn't gone into the NPV table. I could take it and position it early, but me, I'm in Excel. Therefore, I can tell where I will put it. So initial cost I could put here. This is where I said that if there's no working, you need to bring it. And the initial cost is a negative cash flow. It is in year 0. Therefore, it will be negative 9,500. I've decided to bring it early such that I avoid forgetting it. ETC. And I can quickly bring my scrap, which scrap will be in year 5. The project ends in year 5. Times 0.2. That is the figure we got. If you wanted, you could put here in bracket working number 2. That would be working number 2 if you wanted. So we continue tracing our revenue that will appear on the top. So this paragraph is carefully dealt with. This paragraph is carefully dealt with. The annual revenue expected from the proposed diversification is estimated at 7.5 billion in the first year, increasing by 10% in each of the subsequent years. So we need to work out that. I will do it in Excel. So working 2, working 3, working 3. I'm looking for the annual revenue. Annual revenue. And we have got year 1, shall have year 2, and we are going up to year 5. So we have been told this in the first year. I will put it this side. I leave space for workings. You can work within there. So we're going to read the case. The annual revenue is 7.5 in the first year, increasing by 10%. It means 7.5 is here, 7,500, and then it will start increasing by 10%. Since I'm in Excel, I'm trying to find a way. I'll have 7.5, and I will multiply it by 1.10 to represent. That's what it means. So I will grow it. That figure, I will multiply it by 1.10. When I do that, that is the figure I get. However, we continue reading the case. Our revenue, they say the revenue will increase by 10% in each of the subsequent years before declining by 5% in the final year. What is happening? It means in year 3, the way we got that revenue in year 3 is simply we got what? We got 8,250, multiplied it by 1.1. That's how we got that figure. And in year 4, remember with you you're going to write, but me, I'm in Excel, I'm trying to survive. I will be able to get 9,075, multiply it by 1.0, and I will get, I should be able to get that cash flow. But in year 5, that's where the issue is. In year 5, they are telling us to decline. So I will get 9,982. I'm going to use to round off to the nearest whole number. It will decline, so I will multiply by 95%, or basically 0.95, because they have said it will decline 2. Not, let us read again. What is the English? Let us read again. Before declining by. By. It means before, in year 4, it was at 100%. So if the declines, it drops by 5%. It is the reason I'm multiplying by 95 and therefore percent. And when I do that, that would be your revenue computation. I've tried to survive within Excel, but that's how manually you should have done it. I'm going to eliminate the decimals. The onus is on you. You'll do what you want in the exam. So that is it. That is my revenue. If I wanted, I could take it. etc. I think that is it. Let us check again. Let us check again. Our revenue. Let us go back and read to confirm that we are right. The annual revenue from the proposed diversification is estimated at 7.5 in the first year of operation, increasing by 10% in each of the subsequent years. However, there was a point that may not be the answer. There was a point someone is at there was a point. We'll go back to Excel. Year one, the question says the figure in year one, the revenue, I'm trying to be slow, I'm alone here. The revenue is 7.5, which I've taken as 7,500, and it will increase by 10% in each of the remaining years before declining by 5% in the final year. That has been handled very well. However, there is a problem. There was a word somewhere. There was a word that all estimates of cash flows stated above are quoted in current terms and will be affected by annual inflation of 8% starting year 2. That word is very key, starting year 2. So there is inflation. That means when you go back to my working, this is before inflation. You could call them real cash flows. Real cash flows. We are going to adjust them.
Excuse me, Professor. The real cash flows you're getting in the 5th year, it's not 10,988. I think it is 9,484.
But these are really cash flows, and therefore we're supposed to get nominal cash flows. That's why question 1 gets tricky. And therefore, to get nominal cash flows, they say the inflation starts in year 2, and we have been given inflation. We have got inflation of 8%. Because of inflation 8%, the answers we have are not yet adjusted for it. The question carefully says, we go back. The question carefully says, the above cash flows are in current terms and will be affected by annual inflation, which is projected to be 8% effective year 2. So we just need to adjust. And normally, we need to adjust that for inflation. I will use my space here to do it. To get the nominal cash flows, I will get the nominal for year 1 remains. But for year 2, we are going to have 8,250. We multiply it by 1.08. And when you multiply that, you should be able to get that figure multiplied by 1.08. Now, when it comes to year two, when it comes to year two, there's a problem here. 750 is the inflation for year one, is the nominal cash flow. Let me write here inflation adjustment. Inflation adjustment. So we have got the first, no, I'm wrong here. If this is the real, for year one, which is the nominal, because inflation starts in year two, it would mean that in year two, we are going to get the 825 multiplied by 1.08. I'm only wondering why it's not. Oh, it is me doing the wrong thing. Because it was dropping, not growing. So it's going to be equals this figure here. I multiply it by 1.08. It should grow. Wonderful, wonderful. Now it has grown. It has grown. I will use whole numbers. Now in year, pay attention here, this is unique. In year three, the real cash flow is 9075, but we are multiplying it with inflation, which is 1.08. Most of you have been asking this question, but this is year three. The inflation of year one should follow us in year two, and therefore I'm squaring it. That's why you see me raising it to that power. I will be able to say it is this figure times inflation 1.08, but it will be running for the second year. Therefore, I raise it to the power of 2. I should be able to get that cash flow. From that point onwards, in year 4, pay attention here. This is where the confusion is, because the real cash flows differ. So you have to be careful. In year 4, I'm going to have 9983. Grow it by inflation of 1.08, but it's running for the third time, and therefore raise it to the power of 3. In that case, therefore, I'm gonna have that cash flow multiplied by 1.08. I love this to the power of 3, and you should be able to get that. And finally, in year 5, I'm gonna have 9483. Going to multiply it by inflation of 1.08, but it is running. This is the 4th, although we're in the 5th year, inflation started in year 2. So I'm going to raise it to the power of 4. And if I do that, I'm going to have this cash flow of mine. Remember me, I'm in Excel, so I'm finding it easier. Raise it to the power of 4. And at that point, I think that is what I was looking for. That's what I was looking for. Oh, this was too much work. Huh? This was too much work. This was too much work. This was too much. I don't know if he gave it 3 marks here or whatever, but that's how your revenue should have appeared. And therefore, I will take it quickly to my NPV table such that I'm able to say my revenue. But you don't do what I'm doing in the exam, working out, then you take the NPV table. Revenue, this is working 3. Me, I'm in Excel, working 3. My revenue was what? My revenue, the nominal revenue is known. So wait, let me see how I bring those figures. So in year 2, it is 89. is it 89, 89, 10? Then we've got 10, 585. We have got 12, 575. Then we've got 12, 902. That is our revenue. That is our revenue. I don't know how many marks he gave it, but possibly he gave it possibly 3 marks. So we are done with revenue. We are done with revenue. We are done with revenue. And therefore, we are going slowly by. So there's the word here, direct costs associated with the proposed diversification are estimated at 35% of the respective revenue. This is okay. For year 1 to year, me I will do within Excel. That one you can work with, use a calculator. So 35%. So I will go back to my, and I indicate here direct costs. I could go and do it here and add it here. Direct costs. I could do it there, but me I will bring it directly. That one is direct costs. Direct costs. We are being told because direct costs will equal to that figure. You hit it with 35%. You can either pick a calculator and start populating, or you do a separate working. And then when it comes to this year, it will be by, I think, 45%. Let us check again. It says by what? By 45% year 4 to the other one. So I will hit it by 45%. And therefore, I shouldn't have a problem there. That was more direct. It was more direct, and I will do that level. Okay, we're going to continue. So we are done with that. This was pretty fast. The problem was revenue vis-a-vis the issues of revenue, the issues of current terms. I've clarified that now. Diversification in 2. We are here now. Diversifying operations in the cosmetic sector will increase DHL fixed costs. Currently, mark the word currently, meaning it is existing, 2.4 by 30% in the first year of operation. Let me first assemble, then we see how we go by the other. Let us assemble. We could say working, we need to be careful, working for, it's like working for, we are looking for fixed costs. Now these fixed costs, they seem to have the real fixed costs, and that is real, meaning that without inflation, real fixed costs, I think we may end up doing inflation adjustment. Remember me, I'm in Excel, inflation adjustment, and then nominal. At the end of the day, we shall need nominal fixed costs. We need to be careful there. So we go and read together. Let me first highlight this. I prefer to start with year 0. Year 0. And the nominal here, I'm looking for the relevant. There's something there, there's a problem, relevant nominal. But in year 0, we're being told the current in year 0, the fixed cost in year 0, currently we have got 2.4, but will increase by 30% in the first year. Shall increase it by 30% in the first year. Therefore, I'm gonna have here it is 2.4, 2.4, 2.4. But now in year 1, there are very many ways of dealing with it. It's going to increase. It will increase to what? In year 1, I'm going to have 2400. I will increase it by 30%, which is like 1.30. And when I do that, I will get a figure here. I will have 200 multiply it by 1.30. That's what I get. That means the real cash flow that is relevant is going to be the difference. This 3, because the other one was existing. It is existing. It is that 720 I'm looking for. The 20 was existing, not relevant, but I brought it there for the sake of planning. And I think going forward, now we go and read the case. We go and read the case. This is where we go wrong. This takes the fixed costs will increase by faith. We were here. This one we have sorted, but there is a problem. The relevant fixed costs will increase by 8% annually before declining by 6 in year 4. Therefore, I'm still looking at them when they are really before I bring in inflation. That means in year 2, I'm gonna have, this was a number. In year 2, the relevant is the 720. I'm going to increase it by 1.08. That's what you get. You'll equal to that figure, 720, multiplied by 1.08. And in year 3, I will have the relevant, which is 776. Let me round it off for the sake of speeding up. 778. Sorry. This is year 3. Year 3 shall have 778. I will multiply it by multiply it by 1.08. The problem here, this was equal. That figure multiplied by 1.08. Me, I'm in Excel, I don't get worried. So when I grow that, I will be able to get that figure multiplied by 1.08. It's growing. Allow me to reduce the decimal places.